mid-year acquisition. This is where the subsidiary is acquired during the year. When the subsidiary is acquired during the year, that is what we mean by mid-year acquisition. The problem areas in connection with the mid-year acquisition is the determination of pre-acquisition profit. The determination of pre-acquisition profit. So I'm going to give you two ways or two methods of calculating the pre-acquisition profit under mid-year acquisition. Method 1. Pre-acquisition profits or pre-acquisition retained earnings. You have the accumulated profit. Accumulated profit as per the statement of financial position. Accumulated profit as per the statement of financial position. You take the profit in the statement of financial position, less profit for the year. Profit for the year relating to the post-acquisition period. The post-acquisition period. Profit for the year, because you'll be given the profit for the year, or you will be given the statement of profit or loss. You calculate the profit for the year, the one that relates to the post-acquisition period. You are going to apply time apportionment there. It is assumed that profit is earned evenly, unless it is stated otherwise. So this will not give you pre-acquisition profit. So that is method 1. Method 2. You have the accumulated profit, pre-acquisition profit, you have the accumulated profit as per the statement of financial position. Accumulated profit as per the statement of financial position, less profit for the year. Profit for the year. We are not going to apply time apportionment under this method. You just subtract the whole of the profit for the year. You now get profit for the prior periods. Profit for the prior periods. Then you now add profit for the year relating to the pre-acquisition period. So after you might have added that, now get the profit, pre-acquisition profit, pre-acquisition profit, or pre-acquisition retained earnings. These are the two methods of calculating the pre-acquisition profit. So we therefore want to take a work example. This question is obtained from ACCA study test by Kaplan. ACCA study test by Kaplan. On May 1st, on 1st May 20x7, CAR bought 60% of Suzanne, paying 76,000 cash. The summarized statement of financial position for the two companies as at 30th of November 2007 are, you are given for Carl, and you are equally given for Suzanne. You have non-current assets, property, plant, and equipment, investment, current assets, inventories, receivables, cash, share capital, retained earnings, non-current liabilities, 8% loan notes, current liabilities, and the additional information. The following information is relevant. The inventory of car includes 8,000 of goods purchased for cash from Suzanne at cost plus 25%. 2. On 1st of June 2007, Carl transferred an item of plant to Suzanne for $15,000. Its carrying amount at that date was $10,000. The assets had a remaining useful economic life of 5 years. 3. The Carl Group values the non-controlling interest using the fair value method. At the date of acquisition, the fair value of the 40% non-controlling interest was $50,000. 4. An impairment loss of $1,000 to be charged against goodwill at the year end. 5. Suzanne earned a profit of $9,000 in the year ended 30 November 2007. 6. The loan notes in Suzanne's books represent monies borrowed from Carl on 30th of November 2007. 7. Included in Carl's receivables is $4,000 relating to inventory sold to Suzanne during the year. Suzanne raised the check for $2,500 and sent it to Carl on 29th of November 2007. Carl did not receive this check until 4th of December 2007. Required. Prepare the consolidated statement of financial position as at 30th of November 2007. That is the question. So, here, I've told you that to answer questions on group, the first thing you do is to draw the group structure. The group structure. We were told on 1st of May 2007, Carl bought 60% of Suzanne. So, group structure now. Group structure. So you have Carl bought 60% of Suzanne. Carl bought 60% of Suzanne. The next thing is summary of the net assets. Note 1, working 1, summary. Summary of the subsidiary net assets. And the subsidiary is Suzanne. Summary of Suzanne net assets. Summary of Suzanne net assets. You have the one relating to post-acquisition period. You have the one at the date of acquisition and the one at the reporting date, which is date of consolidation. I've told you that the net assets are the equity. And equity comprises, you go to the equity section of Suzanne's statement of financial position. You have share capital and retained earnings, which are $40,000 and $69,000. So we have share capital, that of Suzanne is $40,000, and retained earnings, and that is $69,000. These are the net assets of Suzanne. Now, the share capital will remain unchanged. The one at the date of acquisition will be $40,000, since there were no further issues after the acquisition period. It was not stated in the question that there were additional issues after the acquisition period. Let's go through the notes. Note 1. The following information is relevant. The inventory of car includes 8,000 of goods purchased for cash from Suzanne at cost plus 25,000. I've told you that since you were told inventory includes that, that means 8,000 remain unsold. I've told you that where there are transfers between the members of the group and the portion of the goods transferred have not been sold to the third party, that you will need to calculate the unrealized profit on the portion not yet sold. So meaning that these 8,000 that have not been sold to the third party, you will need to calculate the unrealized profit on that. And I've told you that the unrealized profit should be deducted from the retained earnings of the seller and the consolidated inventory. You are going to calculate the unrealized profit and deduct it from the retained earnings of the seller. Then the question you ask yourself is that who is the seller between Carl and Suzanne? Included in inventories of Carl includes, the inventory of Carl includes 8,000 of the goods purchased for cash from Suzanne. That means Suzanne is the seller. Since Suzanne is the seller, you will need to calculate the unrealized profit on that goods. So by applying the markup and margin. So I've told you when you have cost plus, you know that it is a markup. So unrealized profit now, you calculate the unrealized profit. Since Suzanne is the seller, so you provision for unrealized profit. 25 over 125. I've told you that you add the percentage to 100. You add it to 100 in the denominator. So anytime markup is given times 8,000. And this will give you the portion of the profit that have not been realized. So 25 divided by 125 times 8,000, and that will give us 1,600. 1,600. You are deducting the unrealized profit from the profit of the seller. That is why we are subtracting that 1,600 from the post-acquisition profit of Suzanne, since Suzanne is the seller. So when you are calculating the consolidated inventory, the same 1,600 will need to be subtracted from the consolidated inventory. 2. On 1st of June 2007, Carl transferred an item of plant to Suzanne for 15,000. There is a transfer between the members of the group. I've told you that where there are transfers between the members of the group, 2 different adjustments will need to be made. The adjustment for profit from disposal, or profit on disposal, and the over depreciation where transferred are at profit. So now, this is the transfer price. That is the selling price. Its carrying amount. Its carrying amount at that date was $10,000. An asset whose carrying amount was $10,000 was transferred for $15,000. That means it was transferred at a profit of $5,000. That is the difference between that $15,000, which is the transfer price, and the carrying amount of $10,000. That will give us the profit on disposal of $10,000. Then the question you should also ask yourself, just like the case of inventory, is that who is the seller? Who is the seller? On 1st of June 2007, Carl transferred. Carl is the seller. That means the profit of 5,000, the difference between 15,000 and 10,000, will be deducted from the profit of Carl, since Carl is the seller. So you are not going to adjust for that profit here, because this net asset, or the summary of net asset, is Suzanne net asset, not Carl net asset. It is the subsidiary net asset, not the parent's net asset. So in that case, you will not need to adjust for that profit here. But No, it is Suzanne that is the purchaser. Suzanne is the purchaser. Since Suzanne is the buyer, it means Suzanne will continue to depreciate the asset at the transfer price. Since the transfer price, the selling price of the asset, is the amount it was bought by Suzanne. So if Suzanne were to calculate his own depreciation, Suzanne will calculate depreciation on the transfer price of 15,000 as against 10,000. And if Suzanne calculates his depreciation on 15,000, then there will be an excess depreciation, over depreciation. With that over depreciation now, you are going to, if there is over depreciation, that means the depreciation Suzanne has charged in his financial statement is too much, is in excess. If Suzanne's charged excess depreciation, that means the profit of Suzanne has been abnormally affected. In that case, you are going to add the amount of the excess or over depreciation back to the profit of Suzanne. So in that case now, so you are going to calculate the depreciation now. We have excess depreciation. Excess depreciation. Excess depreciation. And the profit on disposal is the difference between the proceeds of 15,000 and the carrying amount of 10,000, giving us profit of 5,000. Then depreciation now, you are given the useful economic life of the asset to be 5 years. So that means you divide that profit by 5 years. We now apply time apportionment. I've told you that the depreciation in the case of the transfer should be the depreciation from the date of the transfer to the date of the consolidation. On 1st of June 20x7, that car transfer, the date of transfer is 1st of June. The next question you ask yourself is that that is 1st of June 20x7. The next question you ask yourself is that what is the reporting date, the date of consolidation, which is 30th of November 20x7. That means from the date of transfer to the date of consolidation, how many months is that? That is, you have June x7, July, August, September, October, and November, making 6 months. You are going to apply time apportionment to that, times 6 months out of 12 months in a year. So you apply time apportionment. Time apportionment. So the profit is 5,000 divided by 5. That will give us 1,000. 1,000 times 6 over 12 will give us 500. The amount of over depreciation is 500. I've told you that the over depreciation will be added to the profit of the buyer. We are adding the over depreciation because buyer is the one that have recognized the excess depreciation in its financial statement. That is for that. Note 3. The car group values the non-controlling interest using the fair value method at this date, at the date of acquisition. The fair value of the 40% non-controlling interest was 50,000. That is the fair value of non-controlling interest, which will be used when valuing our goodwill and when we are valuing our non-controlling interest. Number 4. An impairment loss of 1,000 is to be charged against goodwill at the year end. I've told you that where goodwill is impaired, the impairment loss on goodwill should be charged against the goodwill and against the profit. But the profit now, we can have the profit of the parent and that of the subsidiary. I've told you that where the policy is proportionate share of the net asset, you are going to deduct the impairment loss from the parent's retained earnings. I repeat, where the parent or the group policy is the proportionate share of the subsidiary net asset, then you deduct the impairment loss from the retained earnings of the parent company. And where the group policy as to the valuation of non-controlling interest is at fair value or full goodwill method. You deduct the impairment loss from the retained earnings of the subsidiary. Now, since the policy, the group policy, they call group values the non-controlling interest using fair value. The policy is fair value. That means the impairment loss of 1,000 should be deducted from the subsidiary profit. So you have impairment loss. Impairment loss of 1,000. You are deducting it. You deduct it from profit and from the goodwill. From the profit and from the goodwill. That is note 4. Note 5. Suzanne earned a profit of 9,000 in the year ended 30th of November 2007. That is the profit for the year of Suzanne. I have told you the essence of this profit. This is not the pre-acquisition profit. This profit for the year should not be confused with the pre-acquisition profit, because it is not the profit that arises at the date of acquisition. This profit does not arise at the date of acquisition. Therefore, it is not the pre-acquisition profit. Pre-acquisition profit must arise at the date of acquisition. So this is the profit for the year. That is why we were told that Suzanne earned a profit of 9,000 in the year ended 30th of November. That is to show that this is the profit of exactly 12 months. And this profit will be used in the determination of pre-acquisition profit. Let me have working 2 for that purpose. Working 2. You can have pre-acquisition profit. I've told you that to calculate the pre-acquisition profit, you start with the accumulated profit. Accumulated profit as per the statement of financial position. Accumulated profit, I'm using the first format, as per the statement of financial position. The accumulated profit of subsidiary, as per the statement of financial position, is 69,000. You put down 69,000. 69,000. Then from that profit now, you have less profit for the year. Profit for the year relating to the post-acquisition period. To the post-acquisition period. Now, at this juncture, you look at the date of acquisition. At the beginning of the question, you were told that on 1st of May 2007, Carl bought. The date of acquisition is 1st of May. And you compare that date with the date of consolidation, which is 30th of November 2007. Now, to count your post-acquisition now, you count from May, June, July, August, September, October, November. Therefore, the post-acquisition period is exactly 7 months. Post-acquisition period is exactly 7 months. At this juncture, you apply time apportionment to that profit. So, how much is the profit for the year with which you want to apportion it? The profit for the year is 9,000. So, you calculate the post-acquisition profit of 7 months times 7 months out of 12 months. That will give us, we have 9,000 times 7 divided by 12. That will give us 5,250. This is the post-acquisition profit. If you now subtract it from the accumulated profit of 69,000, then the pre-acquisition profit will be 63,750. Pre-acquisition profit is 63,750. That is the pre-acquisition profit. You put it there. Now, if you now subtract the pre-acquisition profit from the accumulated profit of 69,000, therefore, the post-acquisition profit will be 5,250. 5,250. That is the post-acquisition profit. After that, Let's go through the other notes. Note 6. The loan note is in Suzanne's book. The loan note in Suzanne's books represents monies borrowed from Carl on 30th of November 20x7. Intergroup loans should be eliminated. Intergroup loans should be eliminated. If you look at that loans, you have 8% loan notes. That is the loan notes they are referring to, which is 20,000. And you were told it was the loan borrowed from Carl. So that means it will be cancelled out. So since it was reported as a liability here, then it is ought to appear as an asset. But it cannot be identified as an asset on the face of the statement of financial position. Therefore, it will have been included as part of the investment here. So that means the investment of 98,000 will include the loans of 20,000. Now, note 7. Included in car receivables is $4,000 relating to inventory sold to Suzanne during the year. I've told you that intergroup receivables should be eliminated from the consolidated receivables. At the same time, it will be eliminated from the consolidated payables. Now, Suzanne raised a check for $2,500 and sent it to Carl on 29th of November 20x7. Carl did not receive the check until 4th of December 20x7. So that is to show that there is a check in transit. So the check in transit should be added to the consolidated bank or cash. Why the difference? Now this is the amount included in the receivables. That is to show that it is 4,000 that will be deducted from the receivables. But the payables, now since 2,500 has been sent as check, then the amount the person would recognize in payable will have been 1,500. The difference between this. That means the amount to be deducted from the consolidated payables will be 1,500. Now, that is all about the adjustment. You can cast this. You can cast it. So, you have 40,000 plus 69,000 minus 1,600 plus 500 minus 1,000. This will give us 106,900. 106,900. Then this one, if you sum it up, it will give us 103,750. 103,750. 103,750. Yeah, the next one. So we have 5,250 minus 1,600 plus 500 minus 1,000. The adjusted post-acquisition profit now of Suzanne will be 3,150. 3,150. So that is the summary of Suzanne net asset. The summary of the subsidiary net assets. So I've told you that there are 3 major workings in the group. Number 1 is the goodwill. The second one is the retained earnings. While the third one is the non-controlling interest. So we want to determine the value of the consolidated goodwill. So we have goodwill on acquisition of Suzanne. Acquisition of Suzanne. So we have, to calculate goodwill, you have the consideration transfer. Please, here if you check this, you have investment of 98,000. That is not final. Anytime you are given a consideration in the statement of financial position, just like this, and another one in the note, and you want to determine the value of goodwill, it is the investment or the consideration given by the way of the note that should be considered, not the one in the statement of the financial position. Anytime you are given investment in the note and investment in the statement of financial position, and you want to determine your goodwill. It is the investment in the note that should be considered in the determination of goodwill and not the one in the statement of financial position. Therefore, 76,000 will be considered now. So we have consideration transferred, consideration transferred, consideration transferred, which is 76,000. Then, at this juncture, we add the non-controlling interest at acquisition. If you check note 2, the car group values the non-controlling interest using the fair value method. At the date of acquisition, the fair value of the 40% non-controlling interest was 50,000. So we have fair value of non-controlling interest, and that is given to be 50,000. If you sum it up, you have 126,000. Then, from that, you less the fair value of the net assets at the date of acquisition. The fair value of net assets at the date of acquisition, you less that. Less fair value of net assets at the date of acquisition, and that is given to be 103,750. 103,750. When you less that, so we have 126,000 minus 103,750, and that will give us 22,250. 22,250. From that, you deduct your impairment loss. Impairment loss note 4. An impairment loss of 1,000 is to be charged against goodwill. So we have impairment loss, and that is 1,000. So if you deduct the 1,000, amount that will be consolidated, the goodwill that will be consolidated, so will be 21,250. That is the consolidated goodwill. So that is the amount of goodwill that will appear in the consolidated statement of financial position. Having completed the goodwill, the next thing is the calculation of the group retained earnings working for. Retained earnings. We want to determine the consolidated retained earnings. So, to determine that, you start with the retained earnings of car, that is the retained earnings of the parent, as per the statement of financial position, and that is 189,000. You have retained earnings as per the statement of financial position, and that is 189,000. Then after that, you have parent, which is so retained earnings. So to determine retained earnings, I've told you that you have retained earnings as per the statement of financial position, which is 189,000. Then in the notes, there is a transfer of inventory. The inventory of car, here, car is not the seller. I've told you that the unrealized profit should be deducted from the retained earnings of the seller, and that has been deducted from the retained earnings of Suzanne. Then the transfer of non-current asset, car is the seller. That means the profit, the difference between the transfer price of 15,000 and the carrying amount of 10,000, which is profit on disposal, should be deducted from the profit or retained earnings of car, since car is the seller. Profit on disposal, and that is the difference between the transfer price of 15,000 and the carrying amount of 10,000. That will give us 5,000. The next one, we now have the share of post-acquisition profits. We have CAR, share of post-acquisition profit of Suzanne. What Carl acquired in Suzanne is 60%. Carl acquired 60% of Suzanne. So meaning that Carl will receive 60% of Suzanne post-acquisition profit. 60% of 3,150. 3,150 is the post-acquisition profit of Suzanne. So if you calculate 60% of 3,150, 60% of that, and that will give us 1,890. 1,890. Then you cast. So you less the 5,000 and you add 189,000. And that will give us 185,890. This is the consolidated retained earnings. Working 5. So we want to determine non-controlling interest. Non-controlling interest. So you start with the fair value of non-controlling interest at the date of acquisition. And the fair value of non-controlling interest is given to be 50,000. 50,000. Then you now have the NCI share of adjusted post-acquisition profit or retained earnings of Suzanne. So since Carl acquired 60% of Suzanne, that means the remaining 40% will relate to the non-controlling interest. The adjusted post-acquisition profit we got the other time was 3,150. 3,150. So 60% was attributable to parent, while the remaining 40% will be attributable to the non-controlling interest. So you have 40% of 3,150. So that will give us the non-controlling interest. So we have 1,260. So when you sum it up, you have 51,260. That is the non-controlling interest that will appear in the consolidated statement of financial position. After non-controlling interest, you can determine the value of property, plant, and equipment. Working 6, because of the adjustment of that, the value of property, plant, and equipment. So we have property, plant, and equipment. So we have that of car. The property, plant, and equipment of car is 138,000, and that of Suzanne is 115,000. So we have car 138,000. We have Suzanne, which is 115,000. And there was a transfer of plant. So we have profit on disposal. The proceeds was given to be 15,000, and the carrying amount was 10,000. So the difference will be 5,000. I've told you that that will be deducted from PPE. Then we also have over or excess depreciation. Either you call it excess depreciation or you call it over depreciation on transfer, which has been calculated to be 500. So you add that. I've told you it will be added to PPE and to the retained earnings of the buyer. So after this adjustment, you have 138,000 plus 115,000. Then we have minus 5,000 plus 500. And that will give us 248,000 500. That is the value of the property, plant, and equipment that will appear in the consolidated statement of financial position. Other adjustments include: 1, we have the loan, intergroup loans. The loan note in Suzanne books represents monies borrowed from Carl on 30th of November 2007. So that is note 7, working 7. Working 7, you look at the movement in investment. As per the statement of financial position, you have the investment of 98,000 in the statement of financial position, and out of which 76,000 relates to cash consideration. And that is 76,000. Then you were equally told that the loan notes in Suzanne books represent monies borrowed from Carl on 30th of November. Then we also have intergroup loan notes. And how much is that loan note? You check. The loan note is 20,000. 20,000. I told you it will be eliminated. So that means the loan note is 20,000. Then if you add this, it will be 78,000. Then the difference of 2,000 is a simple investment, which will appear in the consolidated statement of financial position. The total investment is 98,000. The total investment is 98,000. So this is 96,000. Then there will be a difference of 2,000. This 2,000 will appear as simple investment or ordinary investment in the statement of financial, in the consolidated statement of financial position. That is for investment. Then we also have receivables. Note 7. Let me have working 8. We have receivables. If you check your current asset, you have receivables of 19,000 for Carl and 20,000 for Suzanne. So we have Carl, 19,000. Then we have Suzanne, 20,000. In your note 7, included in Carl's receivables is 4,000 relating to inventory sold to Suzanne during the year. Suzanne raised a check for 2,500. So that means there is an intergroup receivables. Intergroup receivables of 4,000, and that should be deducted. So the consolidated receivables, and that will be 35,000. Then we also have as current asset, you have cash. So working 9, you have cash. You have that of Carl, which is 2,000. We don't have for Suzanne. But we're told there was a check in transit. Check in transit of 2,500. If you have bank separately, or if you have bank separate in the statement of financial position, you will have adjusted that check in transit in the bank. So here you have 4,500. That is check. Then we also have payables. The payables, intergroup payables. The receivables have been adjusted, then you also have payables. So that means you are going to have the payables that will be consolidated. So working 10. Working 10. You have payables. Payables. So that we have that of Carl. The payables of Carl. Okay, we don't have payables separate in the statement of financial position, but we only have current liabilities. Your payable will be part of current liabilities. So you have current liabilities. So that of car, current liability is 33,000. That of Suzanne, the Suzanne's current liability is 23,000. Then you have intergroup payables. Group payable. The receivable was 4,000. Check in transit of 25 has been sent. Then you'll be left with balance of 15 as payable. So you did all the intergroup payables. So 33,000 plus 23,000 minus 15. And that will give us 54,500. That is the amount that will appear as current liability in the statement of financial position. So, working 11. We have inventory. We have that of Carl. The Carl inventory is 15,000. And that of Suzanne is 17,000. We have 15,000. Then Suzanne, 17,000. Then we now have provision for unrealized profit, which has been calculated. We have 25 over 125 times 8,000. That is from the information in note 1. So, and we got 1,600. If you subtract 1,600, 15,000 plus 17,000 minus 1,600, and that gives us 30,400. That is the amount that will appear as inventory in the consolidated statement of financial position. Now, having made all necessary adjustments, we can therefore prepare the consolidated statement of financial position. The name of the parent is Carl Group. We have consolidated statement of financial position as at 30th of November 20x7. Consolidated statement of financial position as at 30th of November 20x7. You start with non-current assets. Non-current assets. As part of our non-current assets, we have property, plant, and equipment. Property, plant, and equipment, working 6, which is 248,500. Property, plant, and equipment, working 6, 248,500. We also have goodwill. And we got 21,250. Goodwill. 21,250. Then, that is goodwill is working 3. From working 7, we have simple investment. Simple investment, that is working 7, and that is 2,000. 2,000. So that is all the non-current assets we have. So when you cast 248, 500, plus 21, 250, plus 2,000, total 271, 750. That is the total of our non-current assets. After non-current assets, we have current assets. Current assets. Current assets. Number 1 current assets we have. We have inventory. That is working 11. Inventory, which is 30,400. 30,400. That is working 11. Inventory. Working 11. 30,400. Then we also have receivables. Working 8. Receivables. That is 35,000. Receivables. Working 8, which is 35,000. We also have cash. Working 9. Cash, which is 4,500. That is working 9. That is all the current assets we have. So you cast. So we have 3,400 plus 35,000 plus 4,500. Total 69,900. So when you add it to the non-current assets. So you have total 341,650. That is total assets. Total assets. Total assets is 341,650. After total assets, the next section is equity and liabilities. Equity and liabilities. As part of our equity, you start with the share capital. And the share capital to use should be that of the parent only, which is 50,000. Share capital, that of the parent only, which is 50,000. Then we have retained earnings. Retained earnings. Working for, which is 185,890. Retained earnings. Working for, which is 185,890. When you add it up, you get the equity attributable to the owner, or equity attributable to the parent. So, which is 235,890. After that, you have the non-controlling interest. Non-controlling interest. Non-controlling interest, that is working 5. Non-controlling interest, working 551,260. 51,260, working 5. 51,260. So when you add plus 51,260, then you have the total equity to be 287,150. After that, you have the non-current liability. The only non-current liability we have in the question is the 8% loan note, which has been cancelled because it was intergroup loans. So that 8% loan notes have been cancelled. So that is why that will not appear in the consolidated statement of financial position. Then we have, let me put non-current liabilities, non-current liability, which is nil. Then we have current liabilities. Current liabilities, which is working 10. Current liabilities, working 10, which is 54,500. 54,500, working 10. 54,500. When you add that, 54,500, you have 341,650. 341,650. That is total equity and liabilities. Total equity and liabilities. That is all about. So this must be in agreement with the total assets. That is all about mid-year acquisition. Before I will give further work examples involving mid-year acquisition, is when I get to consolidated statement of profit or loss, and where I will equally like to solve questions that will involve both the consolidated statement of profit or loss, and other comprehensive income, and the consolidated statement of financial position.